I'm joined by Kallum, Sam and Werner to talk about what's going on in the Middle East. Obviously, it's a fast-moving situation. We're recording this at just before 5 o'clock on Monday. As we speak, actually, the oil price is coming down. Brent crude just below $72, down $2.50 on the day. But obviously, we've seen a significant number of strikes by Israel on Iran and Iran's retaliation. And maybe, Werner, we could just start on the oil market and how important Iran is in the global oil market, just to put it in perspective.
Yeah, sure. Well, Iran currently produces just over 3 million barrels of crude a day, and it exports more than 2 million of oil and other products. And obviously, given its geographic location, Iran effectively controls the main route for key regional OPEC producers to access international markets via the transportation of oil on tankers. Now, what's happened recently, the main fear is that Iran may effectively close the Strait of Hormuz and thereby impacting oil flows. And with 20% of global supply moving through what is potentially a supply choke point, if you like, any negative developments tend to immediately be reflected in oil prices. But so far, production and export capacity have been unaffected, and there have been no signs yet, actually, that Iran wants to disrupt the market in that way. And I think they'd try and do anything to avoid that scenario. I mean, they already have, as we all know, various sanctions against them from the US, the UK, and the EU. So I think they'd be very reluctant to, in particular, affect their top customer, which is China, and the closure of the strait would probably significantly also increase the chance of wider military intervention, which hopefully at this point doesn't seem likely.
And Kallum, maybe taking it further out and sort of thinking about markets and the response so far, how do you think why do you think markets have responded in the way they have?
Well, just to quickly summarize what we're seeing in markets, we're seeing actually a typical, you could say, mildly risk-on day. Global equities are up. The bond market looks fairly stable. There's no major change on the day. Oil prices have come down slightly. The dollar's even weakened today. So we're not seeing, just from the prices on the screens, a risk-off move, which means markets collectively, and I say collectively because sometimes you see inconsistency between markets. You've seen that a lot recently where, say, the equity market seems to be risk-on, but the bond market's telling you something else. Actually, there's consensus across markets that the high probability scenario is the one that Werner has outlined, which is there will be no disruptions to global supply. That, of course, leaves markets prone to a tail risk scenario. Should we see an escalation that could raise the probability that we could get a disruption to oil supplies, then of course things will start to change. Why has the market reacted so calmly? Given that this is a new piece of information, it's probably because actually we've seen this playbook before in the past, but actually this playbook has been unfolding for the best part of 2 years with the Israel-Palestine conflict. I remember actually in October when we had the news that Palestine and Israel the tensions were rising, we saw markets react very badly. And the fear was that if Iran were to get involved, you might see a domino effect around the Middle East. You'd have regional war, and you would get significant disruptions to hydrocarbon markets. Once it became clear that that wasn't happening, alongside major players, major oil producers like Saudi Arabia saying, actually, we're going to come out, we're going to stabilize this oil market, markets then calmed down. And actually, this was a risk that we learned to live with. And so we actually don't have anything new developing here. It's still escalation in the Middle East, risk of oil disruption, but it just takes the story from the past 2 years and puts it in a slightly different dimension. So I think the market's right. It's just this severe tail risk is now on the table.
And how much do you think this is more of a perception that this is the end game rather than it being a sort of new addition?
Because I'm an economist, so I can only speculate like everyone else based on the news. But the hope, I think, would be that at some point, say, Iran and the US would come to some kind of terms over Iran's nuclear policy, and you would get an eventual de-escalation. I think a different way to look at this is to say this seems to be unfolding more quickly and with more intensity than we've seen before. But the playbook is after a couple of days, things tend to settle down. And so at any point we get a signal, say, for a ceasefire or that Iran is ready to have talks, I think then that will be sort of a clear signal for markets that probably these tensions will resolve.
And Werner, going back to your point about the Strait of Hormuz, maybe you could just explain the importance of the straits to Iran's exports of oil, just to understand how much they potentially have to lose if they moved to effectively close the straits.
Yeah. Well, Iran currently produces, I think, on the last numbers I saw, just over 3 million barrels of crude oil per day, so about 3.3. And of that, it exports just over 2 million barrels of oil and other related refined products. Of total volumes of seaborne hydrocarbons that get shipped through the Strait of Hormuz, which I think again amounts to somewhere of the order of 18 to 20 million barrels per day. You can see the context for them as to why it's important. But in a global in a global sense, if you were to cut 18 to 20 million barrels of oil supply out of the market, which is just over 100 million barrels per day, it's about 20% of global supply. So that's why it's so important.
And Sam, thinking about price movements, are you surprised by the reaction of the oil price over the weekend? And what do you think are the key drivers to moving that price at the moment?
Yeah, well, the initial upswing in the oil price came after a period of drift in the oil markets, and that's basically due to ample supply and slow demand. Until Friday, crude prices were broadly moving lower across the year. Werner's given a pretty good outline in terms of the actual numbers around Iranian exports of 2 million barrels. That's just under 2% of global demand. So it's worth noting here that Saudi Arabia and the UAE are capable of raising production quickly. That's by around 3.5 million barrels a day. So that's more than enough to negate that production shortfall. And therefore, we haven't really seen a dramatic reaction in the oil price. But going back to last Friday, a key concern with regards to further upward pressure is the wider concerns of the conflict could spiral into a point where the Strait of Hormuz is closed to tankers or even attacks on oil facilities in the region. But I do see that as unlikely. While no two conflicts are the same, it's worth comparing the reaction to previous shocks in the market. Going back to 9/11, oil spiked 5% in the immediate aftermath. And then once the investors priced in the chance of war in the Middle East and disrupting supplies, but that fell back 25% within 2 weeks as fears that the slowing global economy would weaken oil demand. And then more recently, when we saw the conflict with Russia and Ukraine in February 22, Brent rose by 30%, but that fell all the way back only 8 weeks later. So I think the market is pretty well tuned to some of these shocks and can be a little bit sanguine about it. Overall, I think the current spike will be relatively short-lived, and that's assuming no further escalation.
And are there any concerns with the companies that you're talking to that have assets in the regions that they could get caught up in this, or are people feeling that this is a relatively localized issue?
I think at the moment, most companies see it as relatively localized. One of our stocks under coverage, Energean, have had to shut in their FPSO, so that is a direct impact on them. I suppose with the oil price as well, when you see such companies like Tullow and Cosmos, which are highly levered, we have seen that their share prices improve because obviously a stronger oil price is good for those which have high leverage on the balance sheet. But overall, it's remained fairly steady. In terms of other areas where we are seeing a bit of concern is that this isn't just an oil issue. A key player here is Qatar, and that accounts for 20% of the world's LNG trade, and they use the Strait of Hormuz to ship that fuel. So we are seeing a direct impact into gas prices in the UK and Europe, where they're becoming increasingly tight. We're seeing the UK and European gas prices in particular rise 10% in the last few days alone. So that will become an increased focus, I think, for some clients.
Maybe just to finish, Kallum, put this into perspective of what you're seeing in markets generally.
So often it's almost a lazy thing to say, but the market tends to be the best economist on the street. You know, we've had periods before where we've been presented with very significant risks, but the market's sent a signal to say, actually, this is going to be okay, we'll muddle through. That's roughly been the story of this year, where in April we got the big correction across all risk assets to the news of US tariffs. America scaled back those tariffs, although we're probably looking at a US schedule which is worse than the worst case scenario at the start of the year. But because the rest of the world didn't escalate, we haven't had this tit for tat. And in some cases, actually, some countries with like-minded partners have tried to reduce their trade barriers, UK in particular. Actually, markets have said, this is okay. The global economy can continue to muddle through, especially as the gas shock in Europe over the past 2 years is fading, and as interest rates come down a little, and as China and Germany stimulate. When you put all of this together, this is an environment where you can see some global growth. And so when we bring this particular risk into this context, you say, to Sam and Werner's points, as long as we don't get a new global supply shock in energy, there's probably no reason to downgrade economic forecasts or actually significantly upgrade inflation forecasts, because if we're only talking, say, 5 to 10% on gas and oil prices, the uncertainty effect from this war and the fear factor that goes with an escalation in any conflict will just moderate demand a little around the world. And so the net effect of this may be slightly softer GDP growth for a month or two, maybe a little on inflation, but I wouldn't put too strong a bet on that. And in the end, we'll probably find that stacked up against the risks that we've been hit with over the past few years, COVID, 500 basis points of interest rate increases, I'm exaggerating, but a huge gas shortage in Europe, no gas in Europe, wondering, will we keep the lights on over winter? Actually, what we've seen so far from the trade war and with this escalation in the Middle East, by any historical measure, these are serious problems. In context of what we've come out of, actually, these are smaller scale problems, and that's the thing that the market is telling you. Actually, things are getting less bad, and this is a world in which actually growth, production, trade can continue to expand.
And let's hope everything continues to de-escalate. We'll leave it there, but thank you very much for joining, everyone.